Welcome back to Financial Fundamentals, where we break down money concepts in a way that actually makes sense. Today, sit back, listen up, and learn about something that confuses almost everyone the first time they see it: taxes. Specifically, we are going to untangle the difference between your marginal tax rate and your effective tax rate. By the end of this video, you will know exactly what those terms mean, how they work together, and why understanding them could change the way you think about earning more money. Let's get into it. Okay, so here is why this matters in real life. Have you ever heard someone say something like, "I do not want a raise because it will push me into a higher tax bracket and I will end up taking home less money"? Maybe you have said it yourself. Or maybe you have looked at your paycheck after a good month and wondered why the government's cut felt so big. These are exactly the kinds of moments where understanding marginal and effective tax rates pays off. Literally. The truth is, a lot of people avoid asking for raises, turning down extra income, or even picking up side work because they are afraid of what taxes will do to their paycheck. But here's the thing, that fear is usually based on a misunderstanding of how the tax system actually works. And once you see how it really functions, you will realize it is a lot more fair and logical than it might seem from the outside. So let's start from the very beginning. In most countries, including the United States, the income tax system is what is called a progressive tax system. That word, progressive, just means that as you earn more money, the rate at which you are taxed goes up. Sounds simple enough, right? But here's where people get tripped up. The higher rate does not apply to all of your income. It only applies to the portion of your income that falls into that higher range. This is where the idea of tax brackets comes in. A tax bracket is just a range of income that is taxed at a specific rate. Think of it like a series of buckets. Your income fills up one bucket at a time, and each bucket has its own tax rate. You do not jump from one bucket to another all at once. You fill each one before moving to the next. Now let's define our two main terms so we are all on the same page. Your marginal tax rate is the rate that applies to the last dollar you earned, or really to every additional dollar you earn within that top bracket. The word marginal just means at the edge or the next one. So your marginal tax rate is the rate on your highest slice of income. This is the number most people are thinking about when they talk about tax brackets. Your effective tax rate is different. This is the actual average rate you pay across all of your income when you add everything up. It takes into account that different portions of your income were taxed at different rates and blends them into one overall percentage. Think of it as your real tax rate, the one that tells you what fraction of your total income actually went to taxes. Here's a quick analogy to make this click. Imagine a pizza. The whole pizza is your income. Tax brackets slice that pizza into sections. The first few slices are taxed at a low rate. The middle slices are taxed a bit more. And if you have got a big enough pizza, the last few slices are taxed at the highest rate. Your marginal rate is the rate on that final slice. Your effective rate is the average cost per slice across the whole pizza. Even if that last slice is expensive, the earlier cheap slices bring the average way down. Now here's the big myth we need to bust. Getting a raise that pushes you into a higher bracket does not mean you suddenly pay more taxes on all of your income. It only means you pay the higher rate on the additional amount that crossed into that new bracket. The rest of your income is still taxed exactly the same as it was before. So earning more money always puts more money in your pocket, even after taxes. Always. Let's do a worked example to make this concrete. And remember, these are example numbers used to illustrate the concept. They are not predictions, and tax law changes from year to year, so always verify current rates with a tax professional or the official tax authority in your country. For this example, we are going to use a simplified three-bracket system. Let's say the brackets work like this. The first $20,000 of income is taxed at 10%. Income from $20,000 to $80,000 is taxed at 22%, and income above $80,000 is taxed at 32%. Now let's say our person, we will call her Maya, earns $100,000 in a year. Here's how Maya's tax gets calculated, step by step. The first $20,000 is taxed at 10%. 10% of $20,000 is $2,000. The next $60,000, that is the chunk from $20,000 up to $80,000, is taxed at 22%. 22% of $60,000 is $13,200. The remaining $20,000, the amount above $80,000, is taxed at 32%. 32% of $20,000 is $6,400. Now we add those three amounts together. $2,000 plus $13,200 plus $6,400 equals $21,600 in total tax. So what is Maya's marginal tax rate? It is 32% because that is the rate that applies to her highest slice of income, the dollars she earned above $80,000. And what is Maya's effective tax rate? We divide her total tax by her total income. $21,600 divided by $100,000 equals 0.216 or 21.6%. So even though Maya is technically in the 32% bracket, she is actually paying an average rate of only 21.6% on her total income. That is a significant difference, and it is the kind of difference that matters when you are planning your finances. Okay, let's pause and recap what we know so far. A progressive tax system taxes different portions of your income at different rates using a bracket system. Your marginal tax rate is the rate on your highest slice of income, the last dollar you earned. Your effective tax rate is the average rate you actually paid across all your income combined. And most importantly, earning more money always nets you more money after taxes, because only the new income crosses into the higher bracket. Here's a question for you to think about for a moment. If you found out that a promotion would push your income into a higher tax bracket, would that change whether you wanted the promotion? Think about that. Now let's talk about a few more things that are worth knowing here. In real life, your taxable income, the number that actually gets measured against those brackets, is often lower than your gross income, which is the total amount you earned. That is because things like tax deductions reduce the amount of income the government counts before applying the brackets. A deduction is just a dollar amount you are allowed to subtract from your income before taxes are calculated. There are standard deductions that most people can take automatically, and there are itemized deductions for more specific expenses. We will do a full deep dive into deductions in a future episode because they deserve their own spotlight. It is also worth mentioning that tax systems vary significantly by country. Everything we have talked about today is most directly applicable to countries with a progressive federal income tax, like the United States, but the underlying logic of marginal versus effective rates applies broadly wherever graduated tax brackets exist. If you are outside the US, the specific numbers will be different, but the concept is the same. And even within the US, rates and bracket thresholds change from year to year and can differ depending on whether you are filing as a single person, jointly with a spouse, or in another category. So always confirm current figures with an official source or a tax professional. Here's something else that is genuinely useful to think about. Because your effective rate is the true measure of what you are paying, it is the better number to use when you are comparing your tax situation to someone else's, or when you are budgeting for how much of your income you actually keep. A lot of people anchor to their marginal rate, the bracket number, and end up thinking they are paying way more in taxes than they actually are. The effective rate gives you a much more accurate picture. This is one of those moments where Financial Fundamentals does exactly what it is here to do. Take a concept that feels complicated and show you it is actually pretty logical once you see it laid out clearly. If you are finding this helpful, please go ahead and hit the like button right now. It genuinely helps more people find this content, and that means more people learning the financial fundamentals they deserve to understand. And if you have a friend, a family member, or a coworker who has ever said something like, "I do not want to earn too much because of taxes," share this video with them. It might be exactly what they need to hear. What about you? Is there a money concept you have always found confusing? Drop it in the comments. We go through every comment, and your question might become the next video topic. Subscribe if you have not already, so you never miss an explanation when it drops. So let's bring it all home with the one big takeaway from today. Your marginal tax rate and your effective tax rate are not the same thing, and confusing them leads to a lot of unnecessary fear around earning more money. Your marginal rate is the rate on your top slice of income. Your effective rate is the real, blended average you actually pay. And because of how brackets work, more income always means more money in your pocket. Full stop. Understanding this one concept can genuinely shift how you think about raises, side income, and financial decisions. That is the power of learning the fundamentals. This video is for educational purposes only and is not financial advice. Markets and investments carry risk, including the possible loss of principal. Always do your own research and consult a licensed financial professional before making investment, tax, or money decisions.